Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is July 25th, 2025. I am Luna.
I am JPMorgan.
Yeah, it's definitely been a fascinating period. US stock markets just kept climbing.
Right. The S&P 500
hit a new record, closed above 6,360.
Yeah.
And the Nasdaq Composite, the tech index, also a new peak over 21,050.
Pretty big numbers.
They are impressive milestones, definitely. But, well, it's maybe not the full picture when you dig in.
Exactly, because while those records sound great, it feels pretty mixed underneath, doesn't it?
Mm-hmm.
You had tech, like Alphabet, doing well, up nearly 2% on good earnings.
Strong earnings there.
But then look at the Dow Jones Industrial Average. It actually slipped 0.7%.
Yeah, it dipped slightly.
And some big names really got hammered. Tesla shares, wow, down over 7%. They had disappointing earnings, warning about challenging quarters ahead.
That's a significant drop, and IBM wasn't much better.
No, IBM sank, 9.5%? Also on weak results. So Is this just winners and losers, or is there something bigger happening?
I think it points to something bigger. That's the key question, right? What we're seeing is this split market, a bifurcation.
Okay.
A few big tech stocks are pulling the main indexes up to these records, but it masks, some real weakness, even pain in other parts of the market.
So a narrow rally.
Very narrow. And outside of stocks, things were a bit quieter. Gold prices kind of hovered near $3,360 an ounce. Down a bit.
Why down? Less safe haven demand.
Seems like it. Easing trade tensions might be curbing that need for safety. Bitcoin also pulled back maybe 2-3% to $115,000 after running up recently.
Okay. And what about bonds? The Treasury yield?
Yes. The 10-year U.S. Treasury yield. Still stubbornly high, around 4.48%.
Which means borrowing costs stay up.
Exactly. It reflects the market thinking the Fed's going to hold steady on policy and, those price pressures are still lingering.
Okay. Let's shift gears slightly. The wider economy, global trade. I saw some potentially good news. Hopes for a U.S.-Europe deal, maybe avoiding tariffs?
Yes, there are some hopes there. And also a new U.S.-Japan deal that actually lowered auto tariffs.
And the European Central Bank?
They held rates steady at 2.0%, but they sounded pretty cautious, mostly because of that trade uncertainty you mentioned.
So how does all that global stuff, the trade talks, the ECB's caution, link back to what's happening here in the U.S.?
Well, it's all connected, isn't it? Despite that global caution, the U.S. labor market, it's still looking surprisingly strong.
Right, those jobless claims numbers.
Yeah, initial jobless claims fell to a 3-month low, 217,000. It suggests, employers are generally holding on to their workers.
I sense a but coming.
Well, yeah. The survey data, the PMI numbers, paint a more nuanced picture. Services activity is expanding. The PMI was solid at 55.2.
Okay, that's good.
But manufacturing actually contracted. The PMI dipped below 50 to 49.5. And here's the really crucial part. Businesses are reporting significantly higher costs, and they're specifically pointing to new tariffs as a key driver.
So tariffs are pushing costs up.
Directly. And many businesses say they're passing those costs on to customers. That signals rising inflation pressure building up in the system.
That's a really important point, especially with inflation being such a focus. Okay, so given all these cross currents, what should we be watching for next? What are the key things that could sway the market?
Definitely keep an eye on the Federal Reserve's policy meeting next week. That's huge for guidance on inflation and where rates might go.
Okay, Fed meeting first.
Then, major corporate earnings. We've got tech giants like Apple, Microsoft reporting soon. Their results and outlooks matter a lot.
Big tech earnings, got it.
And key economic data. We'll get the first look at Q2 GDP for the U.S., the PCE price index for June. That's the Fed's preferred inflation measure.
Right, PCE is key.
And, of course, the July jobs report. All of these, really, will shape the market's direction for the rest of 2025.
Okay, so summing it up, we've got record highs in some indexes. There's some optimism floating around. But, and it's a big but, you need to be aware of the risks, these inflationary pressures, especially the ones linked to tariffs, that could make the Fed more hawkish, right? More likely to raise rates.
It certainly could. And that narrow rally we talked about, driven by just a few big stocks, that's also a concern for the market's overall health.
So the takeaway for you listening is, even with these records, it's probably wise to mix that cautious optimism with a real awareness of the potential downsides.
Absolutely. And maybe here's a provocative thought to leave you with.
Okay.
If these new tariffs are directly causing inflation, how might the Fed react differently compared to, say, inflation driven purely by strong demand? Does this specific type of inflation change their calculus? And thinking about your portfolio, what might that difference imply for the months ahead as the Fed tries to figure this all out? Something to ponder. Enjoy the brief? Please like and subscribe. From equities and bonds to global risk sentiment, we deliver day's key market moves, macro trends, and institutional flows in just 5 minutes. Live stream coming soon. Stay tuned.